When you hear real estate investing, what's the first thing that pops into your head? For a lot of people, it's just one big idea. But the truth is, it's a whole spectrum, from the safest of safe bets to some pretty high-stakes gambles. Today, we're going to break down the three key strategies that really define this world: core, value add, and opportunistic. Let's jump right in. So, what really is the difference between a nice, stable property that just prints money every month and a massive project with a huge potential payday? Well, it all boils down to strategy. Each path is a completely different journey with its own risks and rewards. So let's start at the beginning with the foundation. All right, first up, we've got the core strategy. I want you to think of this as the absolute bedrock of real estate investing. It's the most conservative path, right? It's all about security and predictable, steady income. This is where the big, patient players, think pension funds, insurance companies, tend to operate. So what does a core investment actually look like? We are talking about top-tier Class A buildings in the best locations, with great, reliable tenants who are already locked into long-term leases. The goal here isn't to hit a home run. It's about consistently getting on base. That stable cash flow, that's the whole point of the investment. This really paints the picture, doesn't it? The risk is low, and because of that, the returns are too, usually somewhere in that 7 to 10% range. And that analogy is perfect. Core properties are truly the blue-chip stocks of the real estate world. They're dependable, stable, and built for the long haul. Okay, now let's move a little further down the spectrum to the middle ground. This is the value-add strategy. So if core investing is like buying a finished masterpiece, value-add is more like finding a really solid painting and restoring it to its full, magnificent glory. The key phrase here, and you're going to want to remember this, is force appreciation. With core, you're kind of passively hoping the market lifts your property's value. But here, oh no, here you are actively creating new value. You're buying a property that has some problems, but they're fixable. Things like cosmetic issues or maybe just bad management. You fix those things to directly boost its income and therefore its overall worth. So typically, you're taking something like a Class B property. It's still good, but maybe a little dated, and you're putting in some capital to give it an upgrade. This hands-on approach is exactly what drives that higher potential reward. We're in a medium risk zone now, with target returns jumping up to that 10 to 15% range. It is not passive at all. It's all about actively renovating, releasing, and repositioning the property to force its value up. And now, we get to the most aggressive strategy of them all: opportunistic investing. This is where investors are really swinging for the fences. We're not talking about small tweaks anymore. We're talking about major, ground-up transformations. Opportunistic deals involve some seriously heavy lifting. We're talking about buying a plot of land and building something from scratch, or maybe taking a completely empty, rundown building and breathing new life into it. These projects come with huge risks: construction risk, risk in getting the right permits, risk in finding tenants. This is definitely the world of private equity real estate. And here's that trade-off in action. The risk is high, no doubt about it, but the potential returns, they're even higher, aiming for 15%, often much more. The primary goal here isn't immediate cash flow. In fact, you might not see a dime of income for a long time. It is all about achieving that massive jump in value once the project is finally finished and stabilized. All right, so we've met the three main players. Now let's put them head to head and see exactly how they stack up against each other. This chart just lays it all out, plain and simple. It's basically a ladder. As you step up in your willingness to take on more risk, from the stability of core through the hands-on work of value add, all the way to the big bet of opportunistic, your potential for higher returns just climbs right along with it. Let's break this down a bit more. Check out the leverage. That's the amount of debt or borrowed money used in the deal. See how core investors use way less debt to keep their risk low? Meanwhile, opportunistic investors use a ton of it to really juice their potential returns. And the examples just drive it home. A stable, fully leased office tower, a fixer-upper apartment building, or developing a vacant lot from scratch. Three totally different worlds of risk and reward. So, after seeing all of this, there's really one big question left, right? Which strategy is the right one for you? It's not about finding the best one in a vacuum, but the one that's best for your specific situation. And this is really the ultimate takeaway. There is no single best way to do it. It all depends on you. Are you looking for stable, almost retirement-style income? Core might be your answer. Are you willing to get your hands dirty for a few years to get better returns? Then you should look at value add. Or are you comfortable with very high risk for that chance at a game-changing profit? Well, that's the opportunistic path. It's a completely personal decision. So I'll leave you with this to think about. In today's market, with interest rates all over the place and a shifting economy, which one of these strategies do you think holds the most hidden, overlooked potential right now? There's no easy answer, of course, but just understanding this framework is the absolute first step to finding your own. Thanks for diving into this with me.